Claim just $1,500 in home office expenses without a signed T2200, and the CRA can deny the entire deduction and charge you penalties and interest on the tax you now owe. That is the trap thousands of Canadian employees are walking into for the 2025 tax year. Most people still think the old pandemic shortcut works. It doesn't, and I'm going to show you exactly which claims get flagged. I read the fine print so you don't have to. Here's the number that matters. 100% of employee home office claims for 2023 and later must use the detailed method according to the CRA. That means every single dollar must be backed by receipts, a floor area calculation, and usually assigned a T2200 form. The first mistake is claiming expenses that employees simply aren't allowed to deduct. People lump everything together: mortgage interest, home insurance, new furniture, because they paid it all while working from home, so it feels like it should count. But the CRA splits these costs into a strict allowed and not allowed list, and salaried employees can never claim mortgage interest, capital purchases, or furniture. Here's the real cost. A salaried employee in a condo who wrongly claims mortgage interest, insurance, and property tax might deduct $1,220 for these, saving about $354 at a 29% tax rate, per CRA rules. When the CRA reviews it, they deny the whole thing and charge interest on top. The fix is simple: claim only the eligible costs like utilities, rent, and internet access fees, and leave the forbidden items off entirely. The second mistake is clinging to the $2 a day flat rate method. During the pandemic, employees could claim $2 for every day worked from home, up to $500 with zero paperwork. It was so painless that many people in 2026 still assume it applies. But the CRA has explicitly closed that door. The cost here is total denial. The temporary flat rate method does not apply to 2023 and later tax years according to the CRA, so a $400 flat rate claim with no supporting method gets thrown out and interest gets added. The fix is to stop thinking about flat rates altogether and instead prepare a detailed claim with receipts and assigned T2200 for every year. The third mistake is filing your claim without a signed form T2200. People assume that because they truly do work from home, the deduction is automatic. No permission needed. But to claim as an employee, you must have a signed declaration of conditions of employment confirming you are required to work from home and pay certain expenses yourself. Without the T2200, your entire legitimate deduction is at risk. A proper detailed claim of $1,550 saves roughly $449 at a 29% rate, but the CRA can reverse all of it if the form is missing, per their rules. The fix is to ask your HR or payroll team to complete and sign the T2200 before you file, then keep it on record for 6 years. The fourth mistake is guessing the percentage of your home used for work. People pick a convenient round number or claim an entire spare bedroom they rarely sit in, without ever measuring anything. The CRA expects a real floor area calculation, your workspace square footage divided by your home's total finished area. Getting this number right protects the whole claim. A 150 square foot office in a 1,500 square foot home is exactly 10%, a defensible figure the CRA accepts. Inflate it and you invite a review that reverses everything with interest added. The fix is to actually measure your workspace and total finished area, then apply that honest percentage, usually between 5 and 15%, only to your eligible expenses. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this, here's the mistake almost nobody talks about: underclaiming. Colleagues tell each other the home office deduction is worthless now, so renters skip it entirely or claim a token amount. By playing too safe, they leave hundreds of legitimate dollars on the table every single year. Here's what timid filers throw away. A salaried renter paying $30,000 a year can claim the 10% workspace portion, $3,000, which saves about $870 at a 29% rate, according to the CRA. Believing the myth that the deduction is tiny costs you that full amount every year. The fix is straightforward. As a salaried employee, you absolutely can claim the workspace share of your rent, so calculate it and claim every dollar you're owed. And here's the one you're probably making right now. Treating this as a one-year decision instead of a repeating pattern. Combining overclaiming forbidden costs with underclaiming your real rent, a career employee can lose around $11,480 in reversed and missed tax benefits over 20 years based on CRA rules. The same small errors repeated silently every filing season quietly compound into real money. Do 3 things before you file. Get a signed T2200 from your employer. Measure your real workspace percentage and claim only the eligible costs using the detailed method with receipts kept for 6 years. Next, I'm covering the RRSP versus TFSA mistakes the CRA loves to see people make. If you want to catch that, subscribe so you don't miss it.